Why is Realty Income, the monthly dividend company, stock down? And is this Dividend Aristocrat a buy now? We're performing an O stock analysis using the Select 6 analysis. We'll be looking at the most telling financial metrics before we estimate not one but two fair intrinsic values for Realty Income based on their cash flows. Then watch to the end when we give our rating. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing Realty Income for your stock portfolio. Before we get into these valuable metrics, how has O stock performed? Right now, Realty Income trades for $50.59 per share. Year to date, things have been rough on the business as they have to the REIT sector overall. Real estate investment trust ETFs are down. O stock has lost 20% this year, while the S&P 500 is up nearly 13%. Many of these real estate declines have come as rates have risen. There's a slowdown in the commercial real estate market, and there's more fear about these companies supporting their debt. Their stock price isn't all for the business. Right now, O pays a market-beating 6% dividend yield, and they're the monthly dividend company. They're the only dividend aristocrat who pays monthly dividends. They've grown their dividends for each of the last 25 years. They're one of the only REITs that's had this dividend growth. In the last 5 years, O stock is about where it's at today. They're down 20% overall. In the past decade, it's a different story for the business. They're compounding at 2% annually, up 25% overall. When we go back before the global financial crisis, O has compounded at 4% annually. Their average dividend yield is added to this. This compounding in their stock price and their dividends actually lead to market-beating returns over this time. But the burning question is, why are we paying close attention to O stock? Right now, they trade just $2 above their 52-week low. They're down $18 from their 52-week high. There's some short interest with 2.5% of their shares sold short. How big is Realty Income? They're a good-sized business with a $36 billion market cap. Realty Income owns roughly 13,100 properties, most of which are freestanding, single-tenant, triple-net leased retail properties. Its properties are located in 49 states and Puerto Rico and are leased to 250 tenants from 47 industries. Recent acquisitions have added industrial, gaming, office, manufacturing, and distribution properties, which make up roughly 17% of revenue. The company paid $11 billion in an all-stock deal for the REIT in November of 2021. That's changed the business and their financials in a lot of ways, which we'll get into in a second. I want to highlight why they're called the Monthly Dividend Company. They pay dividends for 608 months in a row, and they've raised this dividend 109 times since going public in 1994. Now with that understanding, let's dive into their financials. Metric number one, we want their average return on capital to be above 9%. A typical REIT earns around 6% returns on capital, so we can build in margin of safety based on the quality of the business. They earned below average returns coming in around 4% prior to 2020. Then their returns dropped in 2021. This was as they added on more capital through their REIT acquisition, issuing both more shares for equity, and they took on REIT's debt. Adding on $11 billion to their capital stack decreased their returns on capital. When we average these out, O earns 3.5% average returns on capital in a given year. That's coming in below average, which means this is an X on metric number one. Metric number two, we want to see revenue and cash from operations growth. And O, these have grown. Their revenues are nearly tripled, and that's the same for their cash from operations. This is because of that REIT acquisition in November of 2021. The company's been a pretty active deal maker, making acquisitions throughout this time as well. For the most part, Realty Income has issued shares for these acquisitions. That's not out of the ordinary for REITs. We'll explore that in more detail in our next metric. This is a check on metric number two. Metric number three, we want to see decreasing shares outstanding. This is the opposite for Realty Income. Their $11 billion acquisition for the REIT was an all-stock deal, meaning they issued shares. The company was also issuing shares for their previous acquisitions throughout these years. They've more than doubled their shares outstanding in the last 5 years alone. It's not out of the ordinary for REITs. REITs have a requirement of paying out 90% of their earnings to shareholders as dividends. This means it's less likely that they're retaining their earnings. Still, with a company with a track record like Realty Income, with such stable and steady dividend growth, management really has to be good at deal making in order to create value for the company by issuing shares. You don't want to issue shares of a wonderful business to get poor assets in return. We'll continue to see how some of this has played out for the business in our future metrics. This is an X on metric number 3. Metric number 4, we're putting our previous metrics together. We want to see cash flow per share growth. This is one of the first steps we can take to see if they added value through their REIT acquisition. In this time, we learned their cash from operations have nearly tripled. At the same time, their shares outstanding are more than doubled. Still, they've grown their cash flows per share. This is a check on metric number 4, which means, to recap, so far through 4 metrics, we're split evenly. We have 2 checks and 2 X's for Realty Income. Before we look at the company's balance sheet and get into our fair value estimates, why don't we check in on our bonus? Right now, Realty Income pays a 6% dividend yield. As the monthly dividend company, they're the only dividend aristocrat to pay out dividends each month. But is their dividend safe? That's the question we're trying to answer through our bonus. No surprise, as a dividend aristocrat, they've grown their dividends in each of the last 25 years. This means they've grown these in the last 5 years as well. Still, we want to see that their dividends are supported by their cash flows. That's been the case in all 5 of these years. They've grown their cash flows as well. Likely a good sign for shareholders in the business, they have their lowest dividend payout ratio today that they've had throughout this time. This is especially telling for REITs because of their requirement to pay out that percentage of earnings as dividends. Realty Income supported their dividends in all 5 years, and today, it's exactly what we're looking for. This is a check on our bonus. In recessions, it's businesses with too much debt that can have the biggest losses. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows. Realty Income has more than tripled their net debt position over this time. That's something to keep in mind. They've especially added on more debt in recent years. This was because they assumed the debt from their REIT acquisition in 2021. Still, that's more than doubled their net debt. Typically, we'd look at a historical average to see if their debt's supported. That's not going to be the most telling for Realty Income. So we're going to look at their current cash flows and project these into the future. They produced $2.8 billion of cash flow in their last 12 months. When we multiply that times 5, and look at that over the next 5 years, that only gives us $14 billion of cash flow. In 2018, the company had $6.5 billion in net debt. They ended last year with $18.5 billion. They've kept adding to this. Right now, they have around $20 billion in net debt. Their $14 billion of possible future cash flows aren't enough to support their debt load. This is an X on metric number 5. This is one of the main concerns for real estate and REITs overall. A lot of this is that they fueled their growth using low-cost debt. Today, as interest rates have risen, the price of their financing has increased as the availability has decreased in some cases. Still, Realty Income is one of the bluest chip companies of any REIT, and there are reasons why REITs are able to support more debt than some other businesses, due in part to the large amount of tangible assets in the company. Dig into their filings to learn more about how their debt is structured. The big metric of them all, metric number 6, we want Realty Income's average cash flows divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 ways we'll use their cash flows to estimate a fair value for the company. Right now, they have a $56 billion enterprise value. This looks at both their market cap and their net debt position, giving a view of the company similar to it being a private business. We learned because of their big acquisition in late 2021 that their 5-year average, which is what we normally look for here, isn't going to be the most accurate for the business. So instead, we're going to be basing this metric off their current cash flows, which take that acquisition into account. They produced $2.8 billion of cash flow in their last 12 months. When we divide that by their $56 billion enterprise value, it gives us exactly a 5% current cash flow to enterprise value yield. That's what we're looking for on this metric. If we look at them more usually, they produce $1.4 billion of average cash flow in a given year. Right now, they'd have a 2.5% average cash from operations to enterprise value yield. That's not the most accurate for the business, so we're taking their current cash flows. This is a check coming in on metric number 6. Don't just run out and go buy the business. You'll need to see what a fair value per share is for Realty Income before you stay for a rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Realty Income. This takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We'll start with an average of their cash flows in their last couple of fiscal years. This includes the time for the company after their REIT acquisition. Then we'll use historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for O. They've been a very predictable business in their past. This better informs our assumptions, but it's no guarantee for the future. When we assume this growth for their cash flows, we'll also add in their tangible book value, which gives an estimate of their net worth per share. If we want a market-beating 15% rate of return, which is what Warren Buffett looks for from his investments, at today's valuations, an estimate of O's fair intrinsic value per share is around $65. That's up $15 from today's current stock price. Keep some key points in mind. First, this discount rate is an estimate of total return to shareholders based on their cash flows. It already includes their 6% dividend yield, so their stock price wouldn't appreciate by this full amount. Second, public real estate is coming under some pressure, both as lending has become more difficult and debt has become more expensive, driven by interest rates. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our rating to the company. But first, we've covered their financials. Now we need to address their qualitative factors. These may be even more important for Realty Income. Let's learn what they are. Let's start with a long thesis. Number 1, Realty Income provides a reliable, albeit slow-growing monthly dividend built on a steadily performing underlying portfolio through various market conditions. Number 2, with high to reasonable leverage and potentially ample liquidity, Realty Income may have more financial flexibility than peers to take advantage of any attractive investment opportunities. Number 3, Realty Income's operating history, defined underwriting criteria, and expanded portfolio transparency can comfort shareholders while also maintaining management accountability. But we'd be remiss if we didn't cover the negatives of their business as well. Let's look at a short thesis. Number 1, it will take an increasingly greater volume of attractive risk-adjusted acquisitions to create meaningful shareholder value growth, possibly pushing Realty Income to take more risks as competition expands for its traditionally targeted assets. That may be some of the rationale behind their REIT acquisition, which diversified the business and expanded outside of their traditional assets. Number 2, the value of Realty Income's long-term leases, which altogether exhibit minimal built-in rent growth, are particularly susceptible to rising interest rates and inflation. Number 3, rising interest rates reduce the spread between acquisition cap rates and financing costs, sapping management of its ability to create value through continued external growth. Now let's combine their qualitative factors with their numbers as we give our rating. So far, we've learned Realty Income, stock ticker O, is split on our analysis. They've added a lot of capital to their business, which has lowered their returns. They've also doubled their shares outstanding. They've also tripled their net debt position in the last 5 years alone. Yet they've still managed to grow quite a bit, including on a per share basis. And the company's cash flow to enterprise value yield may look attractive. At the same time, Realty Income supports a growing dividend. They've had the best support for their dividend today of any of the years in their past 5, and they have a pretty sterling reputation as a blue chip REIT. When we performed our discounted cash flow analysis from today's valuations, if you believe those assumptions and you want that market-beating rate of return of 15% like Warren Buffett, a rough estimate of Realty Income's fair value per share is around $65. That's up $15 from their current stock price. It may be worth it to dig in and learn more about the company. As we combine the qualitative and their numbers, Realty Income looks like an interesting candidate for more research. There could be risk, but there also could be reward. If you enjoyed today's O stock analysis, like the video, comment below, and subscribe to the channel for more.